we are saying that there are a lot of developments in the developed countries in the global economy that are going to affect Nigeria economy negatively. One of it is the trade war between the U.S. and China. Those two countries are trading partners, and again, they are very strategic to global economy, the two largest economy in the world. Jointly, they account for over 33% of the global demand for crude oil, and Nigeria being an economy that derives the bulk of its revenue and foreign exchange from crude oil. There is a slowdown in those two countries, then it means that the demand for crude oil will drop. Back with that is the fact that there is increasing supply of crude oil from the U.S., and so oil price may likely drop. A drop in oil price is going to have negative impact on Nigeria in terms of ability of the country to earn revenue and foreign exchange, which may likely affect also value of that currency.
Because I was actually going to that the currency and the foreign exchange. I would like you on twofold to talk about what your outlook for currency is, and then for your outlook for monetary policy.
Okay, so in our report we think that the value of the naira may likely depreciate a little bit this year to 390 from the current level. We also think that the central bank needs to adjust the multiple exchange rate regime that we have and make them uniform. And to do that also, we then assume that the federal government will have also be ready to adjust the price of the PMS to remove the subsidy, such that to be market determined. And when that is done, more revenue will accrue to the government, and of course the users of the consumers of the petroleum products, when they have the confidence that the government will be able to use that, the savings they will get from that, the removal of the subsidy that they are not paying to NNPC, which of course they say yes, this NNPC is importing all crude oil that we consume in Nigeria. I mean, the PMS that will use in Nigeria today, but it's a cost. If the landing cost is more than what we are paying for it, that means the NNPC is using its balance sheet to defray that, and it's a reduction in the amount of money that's available for the government to spend. So if that is done, adjustment in the value of the currency to 390, and then you adopt a uniform exchange rate, and then you remove the subsidy, and government has more money to spend on roads, to spend on schools, to spend on hospital, health care, to build the competitiveness of the Nigerian economy, to enable the country also build structures that will support non-oil revenue. Taxes, government, companies will come to produce and spend and generate more taxes, and also enable us to generate more non-oil export earnings. And so that's the things that we think they need to do. How will monetary policy respond to this? We think that the stance of the monetary policy this year will remain tight. Tight not in the sense of increasing the key interest rates, but using the sales of government securities, open market operations, to influence yield in such a way that it will be attractive for the foreign investors who are here, not to allow them to repatriate their funds. They will be called capital flight, because as you do that, as yields are beginning to rise in the international market, which we expect that will happen this year because of the discussions about the monetary policy normalization, the days of easy money is over. Monetary policy normalization by Bank of England, by European Central Bank, and even the U.S. Federal Reserve Bank will push up global interest rates and yield. As global interest yield increases, it will then mean that from emerging market, yield may likely go. If it doesn't go up, what it means is that their currency will be under pressure because of capital flight, and the response from the federal government, the central bank, would then be to raise rates to enable the investors remain and then attract new ones. Because as yield begin to go up abroad, the attractiveness of the yield in developing countries will reduce.
Right. Away from monetary policy now, another key flashpoint for 2019 is the 2019 elections in Nigeria. And I would like to get a sense from you what your likely scenarios are and how investors should position.
Okay, so unfortunately, despite the promises from the candidates, our view is that we are not supporting any political party or any candidate, but we look at the economic fundamentals and the reality on ground. Whoever wins the election, if it is the incumbent or another oppositional party that wins the election, they will be faced with the realities on ground. And then how do they manage it? Right. Our view is that if the incumbent wins, yes, the two of them, the two leading candidates, even when all of them, the leading candidates, apart from the APC candidates and the PDP candidates, most of the other candidates also have come up with plans of what they are going to do. Yes, looking at some of these plans, if they are going to implement them, and some of the issues that we are raising in this report needs to be addressed. All of them agree that there is a need for adjustment of minimum wage, and the only way it can go is up. All of them agree that our infrastructure needs to be improved, which requires money. How do they fix the money? The major source of our foreign, of our earnings is not in, crude oil. We don't have control over both the price of that product and the quantity that we sell. We don't have capacity in Nigeria here to offtake crude oil because we don't have refineries that are working now that will be able to take this crude oil and process them and sell PMS. One is coming on very shortly.